So we've talked about managing liquidity and cash, debt restructuring, and obtaining new capital. Now let's focus on financial assistance for businesses impacted by the COVID-19 pandemic. As a result of the coronavirus, several legislative and regulatory measures have been promulgated in an effort to assist businesses during the economic downturn, and more relief is coming. In particular, the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act, was passed by Congress and signed into law on March 27, 2020. Now, I'll very generally review the tax credits, incentives, and other relief available under the Act, and I recommend that you view the more detailed presentation on the CARES Act and stimulus package by my colleague, Leanne Anderson. Please pay attention to provisions in the CARES Act for net operating loss, or NOL, carryback claims and tax credits. The CARES Act modifies the tax code by allowing NOLs that arise in 2018, 2019, and 2020 to be carried back for 5 years. You should also closely review tax incentives to improve cash flow and working capital. For example, the CARES Act allows employers and self-employed individuals to delay the deposit of the employer portion of the Social Security tax and 50% of the tax imposed on the self-employment income. The CARES Act also includes several provisions offering support for U.S. agribusiness, ranchers, and farmers. The legislation includes roughly $49 billion in funding for crop and livestock producers, nutrition assistance, and support for local producers to thwart the negative impacts that COVID-19 is having on the U.S. economy. For entities with a direct loan with the Farm Service Agency, or FSA, FSA is extending deadlines for producers to respond to loan servicing actions, including loan deferral consideration for financially distressed and delinquent borrowers. FSA is also suspending loan accelerations and non-judicial foreclosures. You can also consider applying for a Federal Small Business Administration disaster relief loan. There are 2 loan programs referenced in the CARES Act: the Economic Injury Disaster Loans and the Paycheck Protection Program loans. Farmers and agribusinesses alike should also check for lending options through their respective state governments. For example, Illinois offers emergency small business grants and loan assistance. Finally, filing for bankruptcy relief is an option. Family farmers with regular income can benefit from Chapter 12 of the Bankruptcy Code. Chapter 12 addresses the specific economic challenges that individuals engaged in farming face: fluctuating land values and commodity prices, extreme weather, and the impact of trade policies and tariffs. It is a way for family farmers to propose and confirm a plan to repay all or part of their debts over 3 to 5 years. It may be faster, less expensive, less complicated, and more streamlined than Chapter 11, the primary tool for corporate reorganization. Under Chapter 12, debtors propose a repayment plan to make installments to creditors over 3 years unless the court approves a longer period, such as 5 years for costs. Depending on the unique situation, a Chapter 12 bankruptcy may be the best option for financially distressed farmers to propose and carry out a plan to repay all or part of their debts. The Family Farmer Relief Act of 2019, which was signed into law last August, substantially increased the debt limit for Chapter 12 bankruptcy filings from approximately $4.3 million to $10 million. This larger limit will encourage family farmers to use Chapter 12 rather than the more onerous Chapter 11 to reorganize their affairs. Of course, filing for Chapter 11 relief is an option, particularly for those farm operators whose businesses are too large for Chapter 12. Chapter 11 is commonly used to reorganize large corporations and has some provisions aimed at small business debtors and individuals. As a practical matter, however, Chapter 11 cases are costly and complex, which frequently limits its availability to larger debtors with the means to fund a case. In Chapter 11, the debtor will typically reorganize its debts in accordance with a confirmed plan voted on by creditors. Individuals may also seek relief under Chapter 13, the Individual Repayment Plan. In a Chapter 13 case, a debtor commits his or her future disposable income to pay all or part of his or her outstanding debts under the terms of a confirmed Chapter 13 plan. Chapter 13 eligibility is limited to individuals with unsecured debts of less than approximately $420,000 and secured debts of less than $1.25 million. Ultimately, a small to medium-sized family farming operation seeking to reorganize its operations, restructure its debt, and continue as an ongoing business would most likely benefit from Chapter 12, while a large farming operation with debt in excess of $10 million would benefit from Chapter 11. Hopefully the information that I shared in this presentation provides some strategies for agribusiness to avoid bankruptcy and effectively navigate and mitigate financial distress related to the COVID-19 pandemic. And perhaps now is the time to take advantage of opportunities arising from this distress situation to strengthen your agricultural business. Thanks for viewing this presentation. Wishing you and your business health and wellness.